Welcome, everybody. Caitlin, thank you so much for joining us. Tonight's an important discussion because the regulatory environment seems to be changing so rapidly. Markets Policy Partners writes a newsletter about financial markets and government policy. We've been writing about crypto for the last few years, and we expected 2023 to be a year of regulatory clarity. Caitlin has not only been one of the most articulate and compelling spokespeople, but she also happens to, unfortunately, be at the tip of the spear of one of those regulatory actions over the last month that seems to signal that there may be some coordinated efforts afoot to isolate the crypto economy from the US banking system. And tonight, what we'll do is we'll get into some of the details about the Custodia situation towards the end. So for those who, want to know some of the details, hang around till the end. But in the beginning, I'd like to get a feel, if you don't mind, Caitlin, for what was the regulatory environment like for the last 4 years? You launched a bank that was trying to embrace and help shape the regulatory environment. And something seems to have changed, and I'd love to get your perspective on that. And then we'll talk a little bit about fraud and scams, talk a little bit about why this is an important component of the economy to regulate appropriately, and the costs of doing it poorly. And then we'll move into some of the other corollaries in history of when has technology run ahead of regulators, and what happened, and then we'll head into the Custodia stuff. So if you don't mind, Caitlin, I'd love to hear about the founding of Custodia and how you were approaching all of that.
Well, Custodia is 3 years old, founded in January 2020, and we got our bank charter in October 2020. Applied to applied for a Fed master account with the Kansas City Fed, which is the district. Because we're based in Wyoming, that's the district where we would apply. And that happened in October 2020. Due to the slow nature of the turnaround, it's normally 5 to 7 business days. That's what it was on the application at the time. We went ahead and accelerated a plan we already had to apply to become a Fed member bank in August 2021. And then we were blindsided by the sudden decision in January to deny those applications based on everything else that was happening behind the scenes. There definitely was a change in approach in January 2023. And as you said, we were the tip of the spear. On January 27th, 4 things happened. We had the White House release an anti-crypto policy statement. We had the Federal Reserve release a policy guidance that was not put out for public comment. And then simultaneously, all of those things happened with the announcement of the denial of Custodia's membership application. And then later that afternoon, the Kansas City Fed, a couple of hours later, denied Custodia's master account application. Excuse me, and moved to dismiss our pending lawsuit against the Fed, which we filed in June of last year. So that's where we are.
And when you started this, the relations with regulators was what? And I guess even Wyoming, because they play an important role in this too, I think. But
oh yes.
So yeah. So what? There was a spirit of let's get this right, or what? How
Oh my, yes. Yes, absolutely. It was an economic development initiative of the state of Wyoming, and it was done in conjunction with the Kansas City Fed. This is part of the public record. Senator Lummis has talked about the fact that there were more than 100 meetings between the Kansas City Fed and the state of Wyoming in the conception phase of the Special Purpose Depository Institution Charter, which was done by the Wyoming legislature in 2019. And running from the very beginning of the conception phase all the way through to the rules. The Kansas City Federal Reserve commented on the rules that went out for public comment, or 2 different sets of public comments for the Wyoming Special Purpose Depository Institution rules, and then also the 750 odd page supervisory exam manual, the Kansas City Fed also provided comments on that. So the state of Wyoming did not do this in a vacuum. This was absolutely done very much in concert with the Fed itself. And then, as far as I can tell, what happened is that the Washington, D.C. Board of Governors, once they caught wind of it, ultimately slowed it all down and ultimately pulled the rug. And so this is, Custodia is the tip of the spear. There are 4 chartered special purpose depository institutions, a couple of others on the way actually as well. And nobody else wanted to step up and be the tip of the spear with the Fed. And so that ultimately fell to me. Now, this whole thing, this is an interesting comment, and I'll share some new things that I have never spoken about publicly. This whole thing is a business, but as much as it's a business, it's a passion project for me. I love the state of Wyoming. I grew up here. I spent 30 years on the East Coast and then moved back here a few years ago. And it all started with me trying to donate appreciated Bitcoin. This is my 10th year in Bitcoin. Actually, I think coming on actually my 11th year in Bitcoin now. I tried to donate appreciated Bitcoin to the University of Wyoming Foundation in 2000. When was it? 2018. 2017. And ran smack dab into the fact that Wyoming had a bad money transmitter statute. It was one of 3 states that required dollar for dollar reserves in addition to the value of the Bitcoin. And as a result of that, it was uneconomic for the Coinbases and the Circles of the world to do business here, so they had all pulled out. And so when I tried to donate appreciated Bitcoin to my undergraduate alma mater to fund an endowment for female engineers, I was planning to do that just very quietly. And I ran smack dab into the fact that the University of Wyoming Foundation could not accept it. And I said, guys, we got to fix this. This Bitcoin thing is going to be big, and we've got to get this done. I had been an intern in college at the legislature. I had been on the UW Foundation board for 8 years, 2 terms previously. And so I knew everyone and always kept a foot back home. I really do love Wyoming, and this was a passion project. And so what happened is it turned into a snowball. I thought I would just help the state. I came back home to help the state back in 2018, fix the money transmitter statute. And they really just needed someone to explain what was this Bitcoin thing back in 2018, and someone who was trusted and someone who was known. And I checked out from a reputation perspective, and I just rolled up sleeves and started talking to legislators and explaining it, and they just got it. They, in many cases, just instinctively understood it. And there are other reasons for that. I think this fits Wyoming for a whole host of cultural reasons. But what happened is a legislator grabbed onto me at the time and said, what else can we do? What else can we do? What else can we do? And there was a very big problem in 2017. And it happens every 4 years in the Bitcoin industry. And during the bear markets, Bitcoin goes through 4-year cycles. And it's very much just like a commodity cycle. You have the bull cycle and the bear cycle. And during the bear cycle, you can have these enormous drawdowns. The commodity producers, the miners, start losing money, and you see a big contraction in the capacity in the industry. And then it sets up for the next bull market. The bull markets are fundamental, and they're tied to something called the halvening, which is that the Bitcoin price is cut in half, or sorry, the Bitcoin inflation rate is cut in half every 4 years. And after you get some consolidation, typically about 6 months afterwards, you get into these raging bull markets. And again, it all has to do with what happens on the mining side. The producers need to consolidate the fact that their margins have been cut in half because the inflation rate of Bitcoin has been cut in half every 4 years. But what has happened consistently is that, just like with other commodities, when you get a cut in the flow relative to the stock, the scarcity goes up and the price ends up going up. And so that's the reason for the 4-year cycle. And what's the connection to the whole idea of creating a new bank charter? It's because this industry gets debanked every 4 years. And we've been through this before, which is why I am so not worried about the current situation, because we've seen it before. And by the way, I'm also not worried about the collapses that happen as a result of the bubbles that happen at the peak. We've seen those before too. The collapse of Mt. Gox was actually much worse for the industry than the collapse of FTX. It's just that nobody knew about it back then. But back then, Bitcoin itself wasn't as decentralized. And that could have actually, had they had the regulatory crackdown back then. And I specifically remember when Bernanke made reference in a Senate banking hearing that he thought this technology was interesting. That was a huge bull sign, because he wasn't going to shut it down. I think Bernanke is the last Fed chair who could have shut it down. Yeah, but he didn't. And so we've seen these cycles repeat, and they will continue to repeat every 4 years. This is going to keep happening. And so I'm not worried. But Wyoming set about to create the special purpose depository institution charter to solve the very debanking problem. And the reason specifically that it was structured the way that it is that we knew that things move very fast in the digital asset industry. They settle, literally, some digital assets can settle at the speed of light, okay? And so it is fundamentally incompatible for a depository institution to borrow short and lend long, the classic banking model of fractional reserve banking, because you can literally have a bank run within the span of minutes. And so you've got to have basically you've got to turn yourself into a money warehouse if you're going to serve this industry. And we saw that in the bank runs that happened at Silvergate and Signature, the two banks that were predominantly serving this industry in the month of December, and probably continued into January as well. They were doing the classic borrow short, lend long strategy, the classic traditional community banking strategy. And boy, did they both get hit pretty hard as a result of billions of withdrawals that happened in the span of, in their cases, hours. And they had, longer term assets. They had assets with credit risk that had to be sold. I think Silvergate took a $750 million write down on those assets. And then both of them ended up borrowing liquidity through the federal home loan banking system, which created its own firestorm of political issues and broker deposits as well. And both of those have all kinds of issues. But my point is, these things were absolutely foreseeable. So that was one of the problems Wyoming was trying to solve with the special purpose depository institution, which is a non-lending bank and has to hold 100% cash and liquid assets. Yes.
And so the actual task was the legislatures in Wyoming who were trying to form this concept of an SPDI. We're working with the regulators to know exactly what they were worried about, so that you could design something that would go around that. Can you talk a little bit about the details of what is the SPDI? What are the characteristics of it? Then I assume that Custodia was one. And so, and I understand it's a non-lending institution is one of the
correct.
But so when the legislature approved the SPDI framework, it was because the regulators said we would accept this.
Absolutely. Okay. In fact, actually, again, there was a lot of consultation with the Kansas City Fed at the time. This was not done in a vacuum. And the Wyoming Division of Banking, of course, was very involved. Then Commissioner Faulkner, who at the time was the president of the Conference of State Bank Supervisors, he proposed the idea of an uninsured charter. So what we just talked about, where you had to be 100% in cash anyway, is a function of the nature of the business. But the other problem that had to be solved for was the FDIC had just come off Operation Chokepoint, where the FDIC was implicitly cracking down. There was a list of 30 different industries that ultimately were impacted by Operation Chokepoint. That was an Obama era policy. And the Trump administration shut it down, although it looks like it never really was shut down. That there's some inside baseball as to how the bank regulators can implicitly create problems for a management team. There's something called the M in the camel score, which is the management team, and reputation risk is part of that. So you start to get subjectivity. And if there's a policy coming from the politicians up top in Washington that, gee, we don't want you to serve the payday lenders, or gee, we don't want you to serve, some woke industry on the other side of the political spectrum, it can be abused. And that's exactly what we have seen. And that was the history of Operation Chokepoint. So this FDIC insurance is optional for the specific charter. It's an uninsured charter by nature, non-lending bank, required to stay 100% in cash and liquid assets, high quality liquid assets. In Custodia's case, our proposal was to keep 100% of the cash plus 100% of our shareholders' equity in our master account, just sit in cash. Very simple investment strategy. But long story short, the FDIC's reticence to allow banks to serve this industry, which we'd seen cyclically twice before in the bear markets of 2013 and in the bear markets of 2017. And here we are again in the bear market of 2022. It's repeating. Actually, it was really more like 2014, 2018, 2022. It's repeating. The debanking is repeating again. And so we had to find a way to try to solve it so that the legitimate businesses could stay open. You are not a bank. You are not a business in the United States if you don't have a bank account, because the IRS requires you to remit your withholding taxes electronically through a bank account. Yeah. So if you do not have a bank account, you are not a business. And the Wyoming legislature heard testimony from dozens of entrepreneurs who lost their businesses in that 2018-ish debanking wave because they couldn't open up a replacement bank account fast enough. And indeed, the reason Coinbase survived, if we go back to the prior bear market, was that Coinbase, which had lost its bank relationship with I believe, Silicon Valley Bank back in 2013, they were able to replace it fast. And so those who survived really were those who had the durable bank relationships. That turned out to be the most important factor to determine whether the business survived or died. It's incredible.
That answers one of the questions: what is a master account and why is it important? That is it. It's a connection into the flow of the economy, the money part of the economy. And without that, so businesses do that through banks that have a connection, but banks need the connection to be in business. Is that essentially it?
100% correct. Yes. And so we have these centralized points in the banking system in the United States. And it's interesting, you asked me before we started to talk a little bit about the dual banking system, because the United States is literally that, united 50 states. And we have a federal government, but the founding fathers originally created a federalist system where the states were the sovereign unit within the government. And originally, excuse me, before the Federal Reserve was created, and before then the FDIC was created, we had nothing but state chartered banks, with the exception of the central bank itself. And of course, there's a history of the different central banks. But the chartering authority in the United States were the states. It wasn't until much later in U.S. history that there became a concept of a federally chartered bank. And so the states are really the primary chartering authority. And I don't recall the numbers off the top of my head, but it's something like 80% of the banks in the United States by quantity are state chartered. Yeah. And some of them are actually the biggest banks in the United States, like State Street, like Goldman Sachs's Marcus Bank. These are state chartered banks, and they're imbued with the same power as national banks due to the evolution of interstate branching, the Regal-Neal Act. There are laws in states that prohibit states from discriminating against other states' state chartered banks. So if you don't have a national charter, it's effectively the same thing if you have a state charter. And so historically, the states were sovereign. They were the only chartering authority. And then, of course, it evolved to have a national chartering authority. And that's when we have what's called the dual banking system. But the delicate balance between those two is really important.
And part of its importance, I think, is also that there's a lot of experimentation that happens at the state level that it would be thwarted if everything were federal, right? So states Absolutely. Have the ability to compete in the banking system by creating things much like exactly what Wyoming did in this case. Now, an
Absolutely.
SPDI has limited activities and very strong balance sheet safety criteria. And that seems ideally suited for the crypto world.
Yes.
In the case of, I know in your case, you were not even going to be holding any crypto
Correct.
on your balance sheet. Is that the case with all SPDIs in Wyoming, or was that your specific case? And if you wouldn't mind explaining a little bit about why is it that just because it's not on your balance sheet, why does that not pose a risk to the federal system that you're connecting into?
Well, so that's interesting. I don't know about the other business models because in theory, it's plausible, right? And in fact, actually for international banks, the Bank for International Settlements is now allowing up to, I believe it is half of a percentage of tier one capital of digital assets on balance sheets. So the fact that the United States is prohibiting that makes the United States actually not in line with international norms, right? But I don't know about the other business models. But fundamentally, the concept of a special purpose depository institution is it's a custody bank. The whole idea is it's a money warehouse. It's a money warehouse for your dollars, and it's a money warehouse for your digital assets. The digital assets have very specific laws that we haven't talked about yet, where because these are bearer instruments, we understood that we could reimagine what custody would be. And in fact, actually, we went back to first principles about what custody once was, back before we had paper instruments, back when money was gold. It was all money warehouses as the business model. And you literally had a warehouse receipt. That was your deposit. And the bank would hold the gold in custody for you. And the concept, the legal concept around that was something called a bailment. A bailment, everyone is familiar with bailment. It's a British common law concept that essentially says that when you turn your assets over for safekeeping, you retain title to your asset, and all you're doing is giving temporary possession of your asset to the safekeeper to do what you've directed them to do. And so what am I describing? A coat check or a valet parking contract. Those are bailment contracts. And it used to be, before financial instruments were in paper form, when they were bearer instruments, that is exactly how custody worked. So we understood that the nature of digital assets being bearer instruments meant that we could go back to that and essentially not have the banks end up in a debtor-creditor relationship. Very few people understand that you are in a debtor-creditor relationship with your brokerage firm. And it seems strange because you think, my gosh, I own those Apple shares in my brokerage account. No, you don't. Those are IOUs. Just like the deposits in your bank account, those are IOUs too. And your broker, it turns out, owns the shares through a clearing firm, which in turn owns the shares through the owner of the shares, which is the Depository Trust Corporation, right? So you've got these layers of IOUs. And one of the things that attracted me to this technology was seeing just how out of whack the ledger systems in these different intermediaries can be. It used to be that everything had to settle in sequence overnight. So when I started on Wall Street, I started in the summer of 93 and then full-time in 94. The stock trade settled T plus 5 days, trade date plus 5 days later. Why did you need 5 days? Well, you had at least 3 layers of intermediaries, and they were only updating their books and records overnight. Each one had to be done in sequence. So by definition, you needed at least 3 days, and then they added another couple of days if you had an introducing broker, or if you had just a fault somewhere, a break somewhere in the settlement.
A little cushion that benefited them.
It benefited them. And you know what? One of the things that I spoke out about in my early years in Bitcoin and blockchain was some of the shenanigans I observed working in the pension business, running the pension business for Morgan Stanley, where there were hedge funds who knew how to arbitrage those timing differences. And there are so many shenanigans that happen in between the trade and the settlement. And I applauded the SEC very loudly last week when I saw they're moving from T+2 trading days to T+1. They went from T+3 to T+2, I think 3 or 4 years ago. And now they're going to go to T+1. And it raises the question, given that we have the technology to do something almost in real time, why are we not doing it almost in real time? And it still is because there are entrenched interests and you still have all these layers of intermediaries. They still have to settle in sequence. It's just that now they're not necessarily running their systems only overnight. They're actually running reconciliation processes at multiple periods of time during the day, say every 15 minutes now, instead of just once a day.
Do you mind if I'm very interested in the evolution of the relationship that started out so symbiotically between the federal regulators and state of Wyoming and any entity like yours that was interested in participating in this? It started 3 years ago or 4 years ago, 5 years ago. I think Wyoming was more like 6, 7, and your company started 3 years ago, something like that. So at what point did the phone calls not say, oh, that's great? And when your application went in, you got notification from them that everything was fine, right? It was supposed to be 5 to 7 days, and somebody said no problem. And is that all right? And so at what point was it feeling like not good and the phone calls weren't going very well?
Yeah, that's basically right. Again, there was communication, a lot of communication. In fact, actually, our draft business plan got sent by the Wyoming Division of Banking to the Kansas City Fed in May of 2020. So we're coming up this May on 3 years. And so there was a lot of conversation back and forth. And in fact, actually, there was a deal cut between the state of Wyoming and the Kansas City Fed, because the original bill draft, which is out there for anybody to go look up on the internet, the original bill draft had a provision in it that required the Wyoming Attorney General to sue the Kansas City Fed in the event that the master accounts for validly chartered Wyoming SPDI banks were not validly granted, were not granted. And the Kansas City Fed, of course, didn't like that and said, that's not going to be necessary because we're at the table with you and it's not going to be necessary. So
you've already covered all this. That's why you have an SPDI.
That's right. And
we've already pre-approved everything in a sense.
And the deal was cut to remove that language from the bill. And in fact, actually, you most recently saw the Wyoming legislature meets for only a limited number of days per year, and they're in session right now. And you've seen that one of the more prominent supporters of this, who's a Democrat in a red state, he's bitter, and he has proposed to bring that phrase back. I would
guess the legislature has the right to pass anything they want, and if it was taken out in good faith, and there's a reason that was a mistake, they can fix that mistake.
Yes, the state of Wyoming very much feels rug pulled by the Federal Reserve Board of Governors. That's for sure. Yep,
and not so much the Kansas City Fed, right? This is
correct.
I guess there's a move. There's an understanding that there isn't supposed to be this. The Kansas City Fed is supposed to be independent on decisions like this, and these decisions, master account. Are there any situations where they've ever been denied to a bank that meets the what is it? I guess, how do you define a bank that is supposed to get automatic access to a master?
That's in statute. Here again, boy, are we seeing a lot of the agencies in Washington, D.C. not adhere to their statutory requirements. And this is an example. It's in statute what the definition of a bank is, and that is eligible for a master account at the Federal Reserve. And the master accounts are, to be clear, not done at the Board of Governors. They're done at the regional reserve banks, and I think there are 12 of those in the Kansas, or in the Federal Reserve system, of which Kansas City is one, and that's the 10th Federal Reserve District. I don't know. This has been a black box. Actually, there's a law professor, Julie Hill, who has done a lot of research, and she's done a lot of original research on this. And she's done a lot of FOIA requests and a lot of interviews, a lot of talking to people, trying to figure out what is in this black box. So to be honest, we don't really know the history. We don't know how fast the average approval time is. The one-page application, it's only one page because, again, the chartering authority is supposed to be respected. And the chartering authorities have historically always been the states. And then more recently in US history, the OCC chartered national banks as well. But if you have a validly chartered bank, you are supposed to get a master account. Now, the Monetary Control Act of 1980 changed this and clarified it even more than it ever had been before. And the legislative history, there's a lot out there on the legislative history of the Monetary Control Act of 1980 that interprets that added actually the statute at question here, which is 12 USC 248A. And that statute says that the Federal Reserve shall provide services to depository institutions. So I didn't answer your question. What is a depository institution? It's either an insured depository institution, so that's excuse me, the FDIC or the national the NCUA for credit unions, and the second category, excuse me, I've got something in my throat. The second category is a depository institution eligible to apply for insurance. The Wyoming Speedy banks and the uninsured state chartered banks in other states, which include New England states, those uninsured charters are eligible to apply for insurance. And so that's what makes them eligible. And I didn't talk much about the history of uninsured bank charters. Of course, every state bank was uninsured up until the FDIC came about. And so that is also relatively new in history.
And still many remain uninsured too.
There are uninsured banks. There are a number of uninsured banks. And in fact, actually, Professor Hill has in her law review article has a list of a number of uninsured banks that have master accounts, right? So there is some question whether there is some arbitrariness as to who gets these master accounts or not. But the Monetary Control Act of 1980, and especially the legislative history surrounding the statutory language, makes very clear that all depository institutions get access to these services. And in fact, at the time, this was back when banks had to hold a certain percentage of reserves. And the idea was that those reserves had to be held on deposit at the Fed. And the Fed only recently has moved away from reserve requirements and instead replaced the reserve requirements with a capital requirement. But up until a couple of years ago, the reserve requirements by law had to be held on deposit in a master account at the Fed. And all depository institutions are subject, including Wyoming Speedy banks, to those requirements.
And Custodia Bank was offering, or in the business plan said that you would keep 108 cents of assets for every $1 of deposits, I guess.
Correct.
Right? And any other liabilities too. So the idea that, and I think there's a popular view that if the Fed denied your request, that you were a dangerous entity to connect with. And it does seem to be that 108 cents in assets for $1 in liabilities seems to be pretty safe. So that is not, so for anybody that thinks that that might have been a reason, that really doesn't have, that there can't be a very strong reason behind that. Is that right?
Well, one would think so.
I hate to be so obvious. There's also, according to the little bit of research I've been able to do on this, not only is the Bank Act of 1980 say the reserve banks shall make available the master account. There's also been case law after that supports and validates that thesis.
Correct.
Okay.
Yep.
And so how about the relationship between the Federal Reserve Board and the banks? What is their relationship? Or when is it appropriate? When does a reserve bank that's independent need the approval and guidance, or the approval, let's say, of the Federal Reserve Board? Is that common or uncommon?
Well, it varies, and I'm certainly not an expert on the Federal Reserve history. I know a lot about it, but historically, when the Federal Reserve was created in 1913, the banks were all privately held. Okay, and so the regional reserve banks, those 12 regional reserve banks, are actually owned by their member banks. They're private organizations, but they are doing administrative functions. And the Federal Reserve Board of Governors is an agency, and it's subject to the Freedom of Information Act and other agency laws like the Administrative Procedure Act, Congressional Review Act, et cetera. But the 12 regional reserve banks are owned by their member banks. They're private corporations. And so there is ambiguity, and there is a passing of the hot potato, so to speak, as to when the actions are agency actions versus when they are private entity actions, and that that creates a lot of ambiguity, and it's not just in the context of master accounts. It's in the context of the governance structure of the reserve banks. Does the Board of Governors actually get to control who the reserve bank presidents are? There's a lot of history related to that, where the board has been much more actively involved in reserve bank presidency appointments than has been known, but also the Freedom of Information Act. This is something that journalists have sued over, and it's gone all the way up to the Supreme Court. Are the Federal Reserve banks subject to the Freedom of Information Act? Well, they're private entities, and so if they're not government entities, then they would maintain. And by the way, they're inconsistent across the reserve banks, from what I understand. That some reserve banks will say, well, we're not subject to the Freedom of Information Act, but in the spirit of the law, we'll nonetheless share this information. And others just absolutely have a blanket policy of no on everything, every request. So there's ambiguity, and that's part of the challenge.
The wonderful art of this whole situation, or the diabolical art. Let's take 2 seconds, since everybody agrees that the regulations are to protect people's money against fraudsters and scamming artists.
Sure.
Can we talk about that in general? Talk about what fraud and scam has been in the history of crypto, and put it into the context, and certainly in the context of Custodia Bank and what Wyoming is trying to do, and what the Federal Reserve is trying to do, for that matter.
Yeah, I'm not sure what the Federal Reserve is trying to do, but with regard to,
that's a good point. I meant with the spirit in mind of trying to protect people's money from people who will lie to get it from them.
For sure. Yeah. I get where you're going.
Yeah.
If Sam Bankman-Fried had tried to come into Wyoming and get a SPDI bank charter, he would have been laughed out of the state of Wyoming, and frankly, he would have been laughed out of state money transmitter licenses or state trust company licenses as well. He didn't intend to operate a business that was a money warehouse like business model. That seems to be fairly clear at this point.
Yeah,
it was more of a hedge fund, roll the dice, let's take customer funds allegedly and trade them like they're their own funds, and heads I win, tails the customer loses. By the way, a lot of Wall Street does that as well, and then tries to stick it to the taxpayer. But of course, in crypto, there is no lender of last resort. So there is no backup. But there is, of course, a history of scams, right? It really does, interestingly, mirror the scams that happen on the internet. You and I are both of the age where we remember when the internet was created, and we remember when we sent our first emails. And boy, back then, it was just like the crypto industry today. Scam artists and used for things like gambling and illicit finance and porn and just your host of sin industries, so to speak. So net, it's just repeating what happened with the internet. And what's so interesting is that the Clinton administration, actually one of my law school, I went to Harvard Law School, one of my law school classmates worked on the Clinton administration policy. of essentially do no harm. And the Berman Amendment, which essentially said that it's okay if packets of information go through sanctioned countries because it's just information, and you can't, especially back then, you couldn't route packets, away from, you couldn't geofence like you can now. We have the ability to geofence where the packets move on the internet now in a way we didn't back then. But the whole idea was do no harm. Let's stand back and let this develop, and we're not going to crush it. And even though it's filled with scammers and sort of illicit activities, the good that comes from the internet far outweighs the bad. And the Clinton administration certainly was vindicated in its approach.
Yeah. And maybe we can transition now to the mutual fund industry, since you tweeted so eloquently about it. But there is a corollary to what we're seeing right now.
And I have to thank the descendants. There are two descendants of Paul Cabot. They happen to be shareholders of Custodia. And I didn't understand, because when we met, they never shared this with me. The reason that they invested in us is because they saw the parallels to their own uncle, who was someone of very strong character, who very, very clearly understood right and wrong and had a deep sense of morality and ethics. And he spoke out against the scams in the mutual fund industry in the 1930s. And he founded a then fledgling business called State Street, which is, of course, one of the largest banks in the world, a state chartered depository trust company in Massachusetts. But needless to say, that story was incredible. And I didn't even fully understand just how much leverage. It's the scams and the grifters and the corruption. It's the same kinds of things we just saw in crypto, where everybody was rolling the dice and it was unregulated, and you had the grifters come in without respect for basic property rights for their fellow human beings and just stole from them. And FDR in the 1930s during the New Deal was going to crack down and essentially make that industry go away. There were the closed-end fund industry was really in a fight with the mutual fund industry back then. And Paul Cabot, from what I gather, and I've done some of the reading. There's a tremendous book. I haven't been able to finish it yet, but it talks about
to get that.
Yeah, it talks about the strength of his character. And I have to say, when they contacted me, his descendants contacted me to tell me the story, I was just so honored, because boy, does that help create yet another North Star for me, because he was somebody who endured the ridicule of calling out his competitors. And I've done that really consistently for 5 years, calling out the leveraged business models very, very loudly. They were all going to fail. They were all doomed to fail. And a lot of folks said, you're just a Debbie Downer, and this is finance, and we can use our alchemy in finance. And it turned out, no, it was all just leverage, and it was all going to collapse. And then what I privately disclosed, and as shareholders, they knew a little bit of this as well, but I publicly disclosed it on Friday that I had privately been working with law enforcement, as well as trying to warn the bank regulators that it was obvious that there were going to be major problems here, major, and it was going to tip into the traditional banking system. And I was trying to help get ahead of that. And then when it hit, I was providing advice on what are the so-called tabletop exercises that the banks should be doing, that the regulators should be asking the banks that serve this industry, how much of a liquidity drawdown and how fast of a drawdown could these banks handle and still survive. I don't know how far and wide those warnings made it, because of course, I was never at the table like Paul Cabot was with the decision makers. He was able to get into FDR's office. And by the way, he was a Boston Brahmin Republican. He was the opposite political party. And yet FDR had the wherewithal to let in the high integrity innovator. And Paul Cabot convinced FDR, don't kill this industry. We have a way to clean it up. And the two of them worked together to create the Investment Company Act of 1940. It is an incredible story. And I am so humbled and grateful to the Cabots for telling me about the parallel. And that's why they invested in Custodia, because they saw this same parallel. And I didn't even know it existed. And again, I aspire to just a fraction of what he was able to achieve.
So your fight right now is specific, but the regulatory actions over the last month are relatively broad. There have been sweeping statements and speeches made, and it definitely feels like there's a coordinated effort, especially to isolate crypto from the banking industry, but an effort to make some real moves now outside of the legislature. Are there other Paul Cabots out there? Are there other people that you're working with? And what should people do if they share your motivations? What can people do to help out?
Well, absolutely there are. I won't name names. I will say there are only a few people who came out the other side of this whole leverage collapse and all the scams and crimes in this industry with their reputation intact and maybe even enhanced. And those are the people who need to be at the table. And from what I see, none of us have been. There have been meetings with the crypto bros, and they were able to make their way through Washington. And literally, I think, candidly, the Washington, because they were spending so much time with the Sam Bankman-Frieds and others, they just need to wipe the slate clean and hear from those of us who did do the right thing and understand why we spotted what we spotted and understand what we saw that others didn't, and then learn from us. And hopefully there will be an invitation from the Biden White House into the Oval Office for the Paul Cabots. And there are a few for sure. And in fact, actually, when I disclosed on Friday that I had been working with law enforcement to hand over evidence of probable crimes, a couple of others contacted me and said they were doing the same. I was not alone.
Okay.
And by the way, in the industry, we knew about some of these things. Yeah.
And what are there strategies? Because it seems that it's happened pretty quickly, and there ought to be a coordinated effort, I would think. Is there somebody that is Blockchain Association in charge of
Oh,
that?
yes.
Or how is it organized so that rather than not being able to know the exact people, if people are motivated, they can go to the people that are identified and offer whatever resources?
Yes, the trade associations have been great. A couple of them have reached out to us. Yes, there's a lot happening behind the scenes. You will see a lot. And you know, what's interesting is I think the reason why the SEC and the three banking agencies did not pursue enforcement actions as aggressively as they could have. And by the way, I saluted them for that. This industry likes to hate on the SEC. And if you go back and look at my Twitter feed on the SEC and on Gary Gensler specifically, it is balanced. That I will call it like it is. The SEC has done some good things. And one of the things that they did do was stand back more than they probably could have and let this industry evolve. Yes, that meant that some of the bigger scams ended up getting through. But by the same token, here's where I was going. I think they knew they were on thin ice, these agencies. They were on thin ice and moving past their jurisdiction, moving past the statutory authority that they had to take some of these enforcement actions. And Washington, D.C. is a sieve. It wasn't difficult for me to start to hear the real story of what happened to Custodia behind the scenes and who was behind it. This is, whoa, quite a story. And it will come out. Light needs to shine on all of this, and it will come out. I'm confident that it will. And, potentially cooler heads will prevail before that happens. And we'll be back at the table again. But what has happened is that there has been absolutely a concerted effort. And it started with the Fed in conjunction with the White House. And then it went to the SEC. So Custodia was January 27th. The SEC was February 3rd, the following Friday. The OCC was the following week. And then the SEC followed up again last week with more. And the IRS was sprinkled in there as well. Okay, this was absolutely all coordinated, and the White House was involved. That is not an allegation, that is a fact. And it was all coordinated, and it started with the Fed. And the Fed rushed several things with Custodia. There's a lot to come out on all that. But what folks in Washington are telling me, and some of it is explosive, if it is indeed what comes out, is that they decided to throw caution to the wind, and the agencies, broadly speaking, and they know they're on thin ice on the statutory authority that they had to take some of these actions, and that there very well will be lawsuits to challenge them, and that they very well likely will lose. And as a result, the policy is unfortunately going to be made in the courts. I don't have a lot of confidence that Congress is going to be able to do much. We've got a divided Congress now, and when it was all within one political party, they couldn't get something through. And I also spoke out very strongly on Friday against the politicization of this. We haven't talked yet about, it was the White House, the Federal Reserve Board of Governors, the Kansas City Fed, and Senator Dick Durbin all coordinated on Custodia. I had no idea that the White House or Custodia or Senator Durbin even knew who we were. We're not even an operating company yet, right? And so how we ended up in the crosshairs, well, clearly we ended up in the crosshairs of something far bigger than just us, right? But
Yeah,
it is, yeah.
Where the details don't really matter. It's
Correct.
we've got to make it look like XYZ.
Correct.
And so
Well, and a lot of corners were cut in order to do that, right? There was a rush for the Fed to get out first. And then, the Kansas City Fed took the same action, took its action on just within hours of the Board of Governors taking its action. So there's light that needs to be shown on all this, and it will be.
I was hoping that I wasn't naive to believe that the Federal Reserve Board is supposed to be independent of, I get it if the executive branch is coordinating something, that's their right as an entity. It's a little disturbing to hear that the Federal Reserve would have been brought into anything that they were working on like this. And so that unfortunately is what happened.
Washington is a sieve.
Yeah.
Let's see, it'll all come out.
And in Congress, it was feeling for a while that there was a very strong, there was a smaller opposition than there was favor and leaning towards about the crypto economy and it being an important technological development for our country. Has that changed a lot?
Oh, well, certainly those who truly understand it, it hasn't changed at all. They recognize that FTX was a good old-fashioned, it would appear, fraud. Okay, and boy, have we seen those on Wall Street too, and you don't throw the baby out with the bathwater. There is this desire, and actually this gets back to what I've gleaned from what happened in the executive branch and all the agency participation that we just alluded to. There is within the Biden administration, there are two factions. There's a pro-crypto faction and there's an anti-crypto faction. By the way, the same was true with Trump. It goes to show you that this does not cut across political lines, not at all. And I've personally spent time with folks all the way from the progressive end of the spectrum to the conservative end of the spectrum. This is not political. The same thing's true in Wyoming. It's a red state, but some of the most prominent supporters are Democrats. It just doesn't cut across the political line. So that's why I spoke out so firmly against the politicization of this. How did we end up on the White House's radar screen? That came from the Fed. How did we end up on Dick Durbin's radar screen? I bet he didn't even know that when he was criticizing Custodia and Fidelity, he was criticizing two female-run companies and comparing us to Sam Bankman-Fried, who's wearing an ankle bracelet. Okay, so I'll bet he didn't even know that. Okay, but I firmly reject the politicization of this. This is not political, and I salute the bipartisan efforts that did get going before the most recent Congress. It had to be bipartisan to be able to get through the Senate. Right. So the Lummis-Gillibrand bill, they're such interesting. I love both women. They are such interesting, strong women and strange bedfellows. Right. It's Wyoming and New York. Right. It's the financial capital of the world. And this upstart state that was trying to do the right thing in creating a legal and regulatory regime to protect customer interests in in these technologies. And you saw these two senators get together. And as I understand it, Senator Gillibrand reached out to Senator Lummis. It wasn't the other way around, to work together on this. And now, some of the things that came out of the SEC custody rule do attack the dual banking system. They specifically, I'm alluding to the state chartered trust companies. There are some big state chartered trust companies in New York. And it's going to be interesting to see how Senators Schumer and Gillibrand respond to the SEC over that, and whether they have the authority to do some of the to enact some of the rule change that they proposed. I will say again, I call it like it is, that SEC custody rule change. There were definitely a lot of things that are challenging in it, and I think probably will ultimately not survive. And I did a big tweet thread on analysis of it that night. But the SEC is not wrong. State chartered trust companies do not have exemptions under federal statute from the U.S. Bankruptcy Code. And what's the aha for those who are not experts in bankruptcy? A judge in a bankruptcy court can break a contract. And so if you have contractual segregation of your assets from the estate of the custodian, the judge can break that contractual segregation at precisely the moment when it matters most, the only moment when you need it, which is when your custodian goes insolvent. And so the SEC is not wrong. They've been working on this. They actually made reference to the fact that the person who'd been working on it, clearly this was a lot of work went into the 434-page order.
Yeah.
But
I guess Gensler said it was
person,
10 years
10 years
in the making, right?
Correct. Right. But that tells you that this wasn't really aimed at crypto. This was aimed at the state chartered trust companies. And so, again, leaving politics out of it, because everybody is on the Democratic side of the aisle, the two New York senators and Gary Gensler at the SEC. What will happen in the sausage making behind the scenes, I don't know. But that was an attack on New York, the New York state chartered trust companies. And from what I understand, again, I'm not an expert in this, but there are special receivership rules that apply to state chartered trust companies in New York. Here's the problem. And this is the question. I obviously can't give legal advice, but a lot of people are asking their lawyers this very question. Does those state chartered receivership rules, are those trumped by the federal bankruptcy law? And almost certainly they are preempted by the federal bankruptcy law, is what I'm hearing, which is why the SEC did what it did with the custody rule. Now, here's the difference. Wyoming special purpose depository institutions are not trust companies. They are authorized by law to receive deposits. That makes them a bank. And banks have special exemptions. They are not permitted under US bankruptcy code to become debtors in a bankruptcy. So what that means is that they have special receivership rules. And in the event of a bank going down, the assets under custody are protected by statute. And the contract, it's not even just a contract. There is, of course, a contract, but there's a statutory protection on top of the contract that there isn't an ability for the receiver to break that segregation. So you have, this is why all the securities custodians are banks, or like State Street or Northern Trust. They're trust companies that have the ability to take deposits, which makes them a bank under these laws. The SEC wants all the custody to be done by banks because they have better protection of segregation of customer assets in the event of a bankruptcy. And they're not wrong in pursuing that. That has nothing to do with crypto, by the way. Crypto was the trigger because, of course, there are big trust companies that are, one of them, I think, has $50 billion of assets under custody, and it's a trust company. So is it a qualified custodian under the custody rule? That is, I'm sure a lot of people are scrambling to get opinions from their attorneys on that very question.
Well, and we are probably referring to the item that is also a great irony in your application, which is Bank of New York Mellon is still advertising being in the custody business, and I guess it's by virtue of the fact that they had a master account.
Sure.
And so there's this skewing of regulatory favor towards large incumbents rather than
Sure.
new setups. And that's another irony that's frustrating.
Indeed.
There is a question that came in about Custodia and its operations without a master account. And you may have touched on this earlier. You're not really in business if you don't have a master account as a bank.
Well, you can, as a bank, clear US dollar services through a correspondent bank. So stay tuned.
Okay. Good. Well, hopefully the arguments that we've just gone through about who's got the right to issue a master agreement, whether master agreements are a discretionary item at all
Right.
by a Federal Reserve Bank, and whether somebody else was pulling strings appropriately in that setup, and that larger incumbents already have an embedded advantage if a master account isn't granted to a new upstart. Hopefully all that will be resolved favorably as well.
One would hope. All I will say is we have searched for off-ramps. We've searched for reasonable solutions all along. We applied to become FDIC insured and got the answer we expected, which was no, it's not available to a bank that's servicing digital assets. To your point, incumbent banks are doing it, but not a de novo bank like us. We applied to become a Fed member bank, which would have made us federally regulated. And we have taken every opportunity to provide reasonable off-ramps. It is publicly disclosed that after the denial of the membership, where we finally got some answer about questions for which we'd been asking permission, it is very clear, I should make this very clear, Custodia always has had a philosophy of, we ask for permission for everything we do. That is very different than the traditional crypto industry, which has the sort of Silicon Valley, let's ask for forgiveness, not permission approach. And so that definitely distinguished us and made it even more interesting that we were the first one that was the stallion that was shot to scatter the herd. Well, because we were asking for permission, and we finally got the answer on the permission. And just to finish real quickly, we cut out the two activities that the Federal Reserve did not give permission for. But we did not learn that until the day that we had heard the denial of the membership request, and then the subsequent denial that same day of the master account. And so we have gone back and proposed, let's cut those out. Fine, we'll narrow the business plan, we'll broaden the target customer base, and come back. And there are off-ramps. In fact, it is publicly disclosed that we had a statutory right to appeal the membership denial within 15 days of the membership denial. And then the Board of Governors has 10 days to respond. So again, when you consider we had an administrative protection that allowed us the ability to appeal that decision, and the master account decision was handed down without giving us the due process of that 15-day appeal period. We did exercise that appeal, and the deadline for the Board of Governors to determine whether to reopen the decision, which presumably would be with the new business plan, is this Thursday. So we are constantly looking for off-ramps. We did not come here for a fight. We are constantly at the table trying to be the reasonable party here and figure out a path forward. And I would just say also in that vein, I see what has happened here as a lot of theatrics. And I suspect that cooler heads are going to prevail, and that we will be invited back to the table, because this technology is not going away, folks. You can move US dollars outside of the banking system without permission and never touching a bank. Internet native, all you have to do is be able to run code. It exists today. And that this is going to steadily disintermediate the banking system. And so I do not think that the regulators are going to sit with their head in the sand, assuming that this is all going to go away. It is not going to go away. And the rational, high integrity players who should be at the table and who weren't at the table, and who got elbowed out in a lot of theatrics here that were clearly aimed at sending signals to the market. I suspect a couple of us will be invited back. And that is why Custodia is endeavoring to just keep cool heads. We see what happened here. We know exactly what happened here. And having it all confirmed through the sieve of the Washington rumor mill, boy, oh boy, it's quite a story, but this doesn't have to come out. If cooler heads prevail, we're still at the table, folks.
Well, not only were you working along the way to fix anything that might be wrong, you started way before that by working with them to make sure that you were approvable and that you were going to be
Correct.
Actually the example of a regulated entity dealing with crypto assets. So,
Yes.
Caitlin, we have passed the hour mark. There are a handful of questions. Can you see them?
I can't. Nope.
You want to? Okay. One question is there a problem of too many different regulators at the table?
Oh, yes.
And it seems like that used to be more of a problem than it is now. Now there seems to be a coordinated effort by all of them, but.
Well, that's what's incredible, boy. It's so interesting that the folks who know Washington, D.C., and I've spent my time in Washington, D.C. I was a White House intern a long time ago and decided I didn't want a career in Washington, D.C. after that. But I've always, kept ties there and obviously have a lot of close friends and law school roommates and colleagues and the like in and around Washington. But needless to say, yes, there are too many regulators. But what they tell me is that it is incredible that they've been able to coordinate the way that they have. And you asked earlier, I didn't answer your question about the independence of the Fed relative to the White House. That's such an interesting thread because I've seen some narratives come out, and you and I know that the narrative started to come out after the 2008 financial crisis about monetary policy enabling the big fiscal deficits that were that the U.S. has run since the 2008 financial crisis. But more recently, it has to do with the people. One of the prominent industry attorneys privately joked to me that the Fed did a reverse takeover of the U.S. Treasury Department because Chair Yellen took so many of her staffers over to the Treasury Department. And now we're seeing it at the White House as well. Vice Chair Brainerd, of course, is going over to the White House. And then it looks like the rumored replacement for her is someone who came from the Council of Economic Advisors. So you kind of get they're all moving from one agency to the other, but it has to do with the people. And there was a note put out by, I think it was the Rabobank chief economist last week that talked about the blurred lines between the White House, the Fed, and the Treasury Department. But now when you see what happened to Custodia, it raises another just thread along those lines. Is there differentiation? And I sure hope that there would be. That is what was intended to be. But the Washington folks, boy, they are saying it's just stunning that all these agencies who are frankly not playing nicely with each other in the sandbox normally, and when they have to get something done fast and to come with a united front like this. Wow. And now that the Civ is talking, I understand that there are factions by the way, within the agencies themselves, but the anti-crypto faction saw an opening politically. And again, that's why it's just such a shame that Custodia got caught up in that, because we are not a political company, but they saw an opportunity to move against us politically. And we just happened to be the collateral damage. Yeah. Is this a country of the rule of law anymore? Is this a country of due process? I ask those questions rhetorically because, boy, look at what happened to us.
Yep. Well, I have one thing to end on, and that is the last comment that just came in, and it says, "Bravo, Caitlin. Just want to say how encouraging it is to have you as a public spokesperson in this space. You're joyful and positive, and your resilience is truly inspiring. Keep up the good work."
Oh my gosh, thank you. I really appreciate that. This space has been phenomenal. It's I want to thank everybody who's reached out with offers of support. Boy, do we have a deep bench of support. And I didn't go looking for a fight. The board of Custodia didn't go looking for a fight. We were forced into this. And I sure hope that cooler heads prevail, and that those, now that the anti-crypto wing made its big push and got its theatrics and sure sent quite a message to everyone that, all right, now that let's come back to the table and figure out what we really are going to do here, because this technology is not going away. And I do not believe that they want it to be in the shadows. If that's where it ends, the bank regulators especially will play whack-a-mole for years, and they will rue the day. One of our shareholders, Marcel Kazumovich, likes to analogize this to the Eurodollar problem. In the 1950s, the Eurodollar market was created because the Soviets didn't want to, the Cold War had begun, and the Soviets were selling their oil for dollars, and they didn't want to deposit the dollars in a US bank. So they got a British bank to agree to open a US dollar deposit account. And that British bank was not regulated by the Fed. And the dollars that they created in that account were not part of the money supply reported out by the Fed. And thus the Eurodollar market was born. That Eurodollar problem of US dollars being able to be created outside of the banking system is a massive problem for the efficacy of monetary policy, but at least the global central banking community was able to cooperate so that at least the Fed, you can't measure how big the Eurodollar market is, but at least they have some common capital requirements and some understanding of how the correspondent banks work. So ultimately the Fed does have some visibility into it, not perfect, but more than certainly they did back in the 50s and 60s when this got started, and it just ballooned. And some estimates are that the Eurodollar market is bigger than the onshore lit market, if you will, for US dollars, right? But here's where I'm going. And this is hat tip to Marcel. The US dollar problem of all the 8-ish billion people in the world being able to run code on their phone and create US dollars on their phone. This is the Eurodollar problem writ large, absolutely uncontrollable. And it's as these network effects propagate in these networks where anyone with a phone can become a US dollar bank, that is a problem for the bank regulators. And it gets back to maybe this is a good topic to end on. It gets back to how the Clinton administration thought about the internet. Most of the internet is done through lit markets. Most of us don't use the command line interface to make a phone call. Okay, even though we could, what ended up happening, just like when voice over internet protocol was created, at first everyone said, oh, pshaw, that's not going to affect the big giant telephone companies with their copper wire networks. Well, it only took 8 years for those copper wire networks to be completely obsoleted by the combination of broadband and voice over internet protocols. And those companies had to pivot to survive. And I see that traditional banks are going to have to do the exact same thing. This internet native US dollar technology is not going to be uninvented. And we're just repeating the same thing that the telecom regulators repeated in the 90s, and repeating the same thing that unfortunately, we're making the opposite mistake, if you will. We didn't learn from what the Clinton administration learned, which is if you let this develop, people will naturally go to the safer places to do business. Tor exists, okay, but the vast majority of internet traffic is in these lit markets through the ISPs. And it's just like the voice over internet protocol. You could make an unsurveilled phone call if you wanted to, but most of us use Verizon, AT&T, T-Mobile, and of course the overseas carriers for non-Americans as well. Most of the activity naturally goes to the regulated lit markets. That's where the regulators should be spending their time, figuring out how do we create markets where people vote with their feet to come to a regulated entity and stay away from the offshore entities like FTX, because they have an onshore regulated alternative that they trust, just like trusting Verizon or AT&T, just like trusting your internet service provider instead of being in the wilds of Tor. That is the game theory. That is the behavioral science that the regulators should be thinking through. And I think they've made a grave mistake, and I understand it's all political, and it very well could be reversed. And so when those cooler heads do come to the table and try to figure out, all right, from the ashes of all this, who is going to be the regulated entity that is going to get the green light? Custodia is going to be there, and we sure hope that we will finally have a seat at that table, and that all of the cruft that those crypto bros left when they met with Gensler and Powell and Yellen, that all that crap just gets wiped away, and those who truly did prove our mettle and came out with reputations intact should be the ones at the table this time.
Absolutely. Very compelling. And for those here who are still on, who are compelled to help you, how should they contact you or the movement, or what would you encourage people to, how can we act if we want to support this?
Well, join the trade associations. There are a few that are very active. We're not members of any of them at the moment, but they're all talking to us because they want to help. And so stay tuned. And then
Okay.
obviously, if you want to reach me, LinkedIn messaging is probably the easiest way, or info@custodiabank.com. And then follow me on Twitter or LinkedIn, or I am now on Nostr, which is a Bitcoin adjacent social media platform that Jack Dorsey has made famous. And if anybody thinks that internet native US dollars are going away, join Nostr and watch what is going on. The Lightning Network, the way it works with you, basically any fiat currency can move over the Lightning Network using Bitcoin as security. And the amount of activity going on in the Nostr network for Lightning is staggering. And I just saw this is growing far faster than Bitcoin itself. I just saw that there are 182,000 Nostr users, and this technology is only 2 months old. The growth curve of this is incredibly fast, and it's got the Lightning Network as its native currency. Wow, it's incredible. So find me on Nostr as well.
Awesome. Great. Caitlin, it's been delightful. Thank you so much. Thank you, everybody.
Appreciate it. Thanks.
Have a great
Good night,
weekend.
everyone.
Bye.
Bye-bye. You too.